Today I'm going to be talking about a dividend investing strategy called Dividend Stripping. So if you want to know what it is and whether it's right for you, keep on watching. Okay, so what's dividend stripping? Dividend stripping, also called dividend capture, is a strategy where you buy shares in a company just for the dividend. You buy before the ex-dividend date, and when the company goes ex-dividend, you sell the shares. You either sell on the ex-dividend date or a few weeks later. That way you get the full dividend payout, even though you may have only owned the shares for 1 or 2 days. It's a short-term income strategy. So recently I had to quickly buy into a company because the dividends that I thought I was getting in that month were coming in the next month, and I try to have dividends coming in every single month. So I had to quickly buy into this company, but it's not a company I want to keep long term. So I thought I would try a bit of a dividend stripping strategy. So I bought the shares before the ex-dividend date, and now I'm still holding them, but I plan to sell very soon. You might be asking yourself, is this allowed? Can I only own the share for 1 or 2 days and still get the full dividend? Yes, it's perfectly legal to do so, but there are caveats which I'm going to explain now. Because while it's possible, it's not always advisable to hold for such a short term, because you want to get the best bang for your buck, right? So let's look at how to get the best out of this strategy. First, let's understand the 45-day rule. In Australia, to stop the blatant dividend stripping where investors would buy the day before the ex-dividend day and then sell the day after, they implemented a 45-day rule. The rule states that if you want the franking credits that are associated with those dividends, that you must be holding the shares for at least 45 days, not counting the trade day. I believe there's a similar rule in the US for 60 days. Franking credits or tax credits are just the company tax rate that's already been paid on those dividends. So if the stock is fully franked, the company has paid the full company rate of 30%. So at tax time, that either reduces your tax, or if it's more than the tax you owe, you get that back as a tax refund. So let's just say I'm a fan of fully franked dividends. So does that mean that you have to hold for the 45 days then? Not necessarily, it depends on a few things. Firstly, this only applies if a company has franked dividends. If the company doesn't pay a franked dividend, say like Stockland, then you don't need to worry about it. You can hold this for as little or as long as you like because there is no tax credits. If a company is fully franked, like say Commonwealth Bank, and you want the tax credits, then yes, you do want to hold for at least 45 days to get that benefit. But you may not care about the tax credit, which means you can buy whenever you want and sell whenever you want. It really depends on your situation and your goals, because whatever strategy you implement has to take into account the share price as well. So let's talk about that. The usual pattern of dividend reporting usually goes something like this. First, we have the announcement day. The announcement day is the day that the company releases a statement to the stock exchange and the shareholders on when it's going to pay the dividend, how much of the dividend it's going to pay, and of course the ex-dividend day. There's also the record day, but investors don't need to worry about this. This is just for the company so that they can record who is owed a dividend and who is not. So what happens on announcement day, people who want to buy just for the dividend start buying the shares. And if we're in a rising market like we are now, the share price often goes up. It slowly rises in value until the ex-dividend day hits. The ex-dividend day is about 2 to 4 weeks after the announcement day, and it's the day that you no longer need to hold the stock for. You've got the dividend, all is good. So what you'll find is everybody who has bought for the dividend, on ex-dividend day, the stock price goes down. That's because people have got the dividend, now they want to sell. In a perfect market, the amount that the stock falls is usually equivalent to how much the dividend payout is going to be. But as we know, it's never a perfect market. Sometimes it doesn't fall as much, sometimes it falls even further. You just never know what it's going to do. So now we get to the payout day. That's the day the checks get sent out or the dividend turns up in your bank account. The payout day is usually between 2 weeks to 2 months after the ex-dividend day. All companies vary on how soon they pay out. So that's generally the way it goes. You need to be aware of the general pattern of the stock price over the dividend cycle so you can make the most of your dividend strip. Because there's no use buying at one price, getting the dividend, but the value of the stock has gone down, so you've lost in the overall. So obviously what you want to go for is to sell at a price that's near what you bought it for. That way you're not losing out on value and you still get the dividend. Each company varies on how long it takes for the price to recover. Sometimes it can be just days, other times it takes weeks or months. It also depends when you purchase the stock as well. If you purchased the day before the ex-dividend day, you've probably paid a much higher price than someone who's bought weeks before. So how can you implement this strategy and profit? First and foremost, Dividend stripping will not work in a falling market. It only works in a rising market and sometimes in a flat market. So if the market is in decline, don't try this method. Dividend stripping is just not profitable in a falling market. If you can, buy before the announcement date. You can go online to check when that company paid in the previous year. It's generally around the same time, give or take a few weeks. That way you can buy before everybody else jumps in. Now, the cons of buying before the announcement day is that you don't know exactly what the dividend payout is going to be. But for a stable company, it's a good way to lock in at a reasonable price before it starts to rise. If you want to wait until the announcement day so you know what the dividend is going to be, then try to buy as soon as possible, as far away of the ex-dividend day as possible. The earlier, the better. Once the stock goes ex-dividend, wait. If you want the tax credits, you're going to have to wait 45 days from when you purchased it anyway. What you're waiting for is the price to recover from about the similar price as you paid for it. And don't forget to take into consideration brokerage costs as well. I've got two examples here of when a dividend stripping strategy would have been perfect and when it's not working quite as well. The first is Rio Tinto. Rio Tinto went ex-dividend on around the 10th of the 8th, and the price recovered within 2 weeks. So that would have been a perfect stock to use for dividend stripping. The price has recovered, you've got the dividend. If we now compare that to National Australia Bank, it wouldn't have worked as well. As you can see on the chart, there's really strong increase in purchasing right before the announcement. People weren't happy with the announcement. The share price started to fall. It went ex-dividend, had a massive jump down, and it still hasn't recovered. The difference between these two charts is that Rio Tinto was in a very strong rising pattern, whereas National Australia Bank wasn't at the time. So what's a good time frame to hold for? I like a time frame of about 60 days, give or take, because it skips over those buyers who are only there for the 45-day rule, and I find you've got a little bit more time to make sure that the stock price has recovered. Or you might decide to wait longer, perhaps to the next dividend payout. Depends on the stock price, and what your goals are. Also depends if you want to pull that money out and use this strategy on a different company, so you're constantly getting dividend payments and repeating the process. So that's it. That's the dividend stripping strategy. I hope you found it useful, and I'll catch you in the next video. See you later.